A very good afternoon, good morning. Welcome to HYCM's online trading workshop with myself, Giles Coughlin, the Chief Currency Analyst here at HYCM. Hope everybody is doing very well. Looking forward to taking us through the session and running through a few things with you all. Don't forget during the session that if you have any questions, we will deal with questions at the end of the webinar. So just pop them into the question and answer box. As folks are coming into the webinar, just going through this quick disclaimer, reminding ourselves that as we talk about entries, exits, different currency pairs to trade, the whole idea of this webinar is that you look over the shoulder of someone with a professional trading background, you see about how I go about making my trading decisions, and so you can learn from that for yourself in your trading. So that's the whole idea and how it works. Without further ado, as folks are coming into the webinar, we will get on with the session. Now, whenever you're learning to trade, or whenever you learn to trade, you're always looking to do one key thing, and it's this. You're looking to back strength against weakness. I use this diagram because it helps underscore what you're trying to achieve. The strong arm is almost always more likely to beat the weak arm. Why? It's because you'd expect the strength to overcome weakness. Now, in this instance, you'd always expect the stronger arm to overpower the weak one. Well, in the currency markets, we're trying to do exactly the same. We're trying to pair strength with weakness. That is what we want to do. We want to have the odds, the probabilities in our favor by trading currency pairs that are more likely to go one direction. We want strength against weakness. And this is why my style of trading, for those of you who've been attending for some time, I always want to combine the fundamentals and the technicals together, because that gives you the highest probability of accessing a trade. So in a few moments, we are going to deal with this and find a currency pair for us to trade today in the current market conditions. And we're going to go through a currency pair and a few different options that there are today and just go through the rationale for it. But before we do, we also have a special topic, and this special topic is a very, very important topic indeed. And that topic is, why is the US dollar the king of currencies? Now, this is an important thing for you to really get your head around. If you look at my trading screen, which you should see, let's have a look. Yeah, if you look at my trading screen, which you should see here, you can see that I've got the major currency pairs all outlined together and the US dollar in the bottom right-hand corner. The dollar index is the king index for the major currency pairs because it drives and pushes and pulls the major currency pairs. The US dollar is the king of currencies for a very particular reason. You know, for many retail traders, they see FX pairs as all kind of equal players on this stage. You have the pound, US dollar, euro, US dollar, Aussie yen. They're all sort of seen as equal pairs, but actually they're very far from equal. And the one currency that tops them all is the US dollar. More than 70% of all currency transactions involve the US dollar. And if you look at the world's GDP, you can see that around a quarter of the world's entire GDP comes from the US. You can see here, nearly 1/4. So when the US does well, the whole world benefits. And the United States has a unity of 50 states that the European Union can only dream of. And many of the EU states have national identities that are so strong, they have no notion of being European. Whereas actually the US makes 24% of the entire world's GDP and is highly, highly unified. You know, the three main trading blocks in the world are: one, the US, number two, China, and number 3, Europe. So you can see that when you consider that Europe, although a very large trading bloc, it's A, smaller than the US, and B, it's nowhere near as unified as the 50 states of the US. And some of the reasons for the US's greatness in terms of a nation is quite obvious. The US has 3 major parts. You've got the East Coast, you've got the Great Plains in the middle, and you've got the West Coast. And the first most obvious point is the US has got access to 2 oceans, the Pacific on the East Coast, the West Coast, and the Atlantic on the East Coast. And you've also got the Mississippi that flows into the Gulf of Mexico, okay? And this huge nation is very, very well unified. And remember that almost everyone in the US has a gun because of the gun laws. So as a nation, it's a very secure and stable nation that some people, almost argue that the US is invincible. Now, obviously, that's not the case, but it is a very, very strong country. So you can see that during the global financial crisis, there was a massive rush to the US dollar. This is when the crisis really took hold. And if you just look at we'll just look at stocks, we'll just put the S&P 500 on top of this. You can see that in the turquoise lines, the S&P 500, as the S&P 500 fell, the US dollar rose strongly. It's because the US dollar, in times of extreme crisis, acts as a safe haven currency. The US dollar is the de facto global currency. And it became the world's reserve currency after the negotiation of the Bretton Woods Agreement in 1944, when a decision was made that the world's central banks would use fixed exchange rates between the US dollar and their own currencies. So the US dollar has been kept by governments in reserve since countries and companies around the world trust the US dollar. And that's why we saw the dollar rising so much on safe haven demand, alongside the Japanese yen and the Swiss franc, even as global equity markets fell. So why is the US dollar in so much demand? It's that the US is the world's largest economy. It's economically, political, stable. The US dollar is much less prone to large fluctuations in price than, say, like the Turkish lira or the Argentinian peso. That's why some countries like Ecuador, Zimbabwe, they prefer to use the US dollar as their own currency rather than their local currency, because it helps them have a stable currency that's less prone to wild swings. So this is why the US dollar is the king of currencies. And this is why the US dollar, when it drops and falls and moves, pushes along the major currency pairs. So that's a very key relationship to have firmly in your head. Okay, so that if you don't know that already, know about that, learn about that. I've written an article on this on HYCM's blog. I'm just going to send this article to you so you can go through this and read it in your own time. Okay, it's an article that I've written to help traders understand this key relationship going forward. Okay, returning back to the main screen. So today what we're going to do is we're going to run through how we back the strong against the weak. Okay, so I'm just going to run through the kind of things you want to do day to day. So going back to the charts, I'll just run you through what my day looks like, and the first things I do as I come to look at the market. So first of all, take a look at equity futures. So look at the equity futures markets, and you can see, if I'm doing the analysis now, look, they're all above that pivot point. Equity markets are all rising higher. Then we look at volatility moving lower. It's all positive for risk sentiment. Equity markets moving higher. Looking at bond yields, see that bond yields have been quite flat today, but generally supported. So in bond markets, generally supported, but quite flat on the day. We're looking at bond yields here. So as the yields rise, that's positive for risk. So we want to see rising yields is positive for risk sentiment, falling yields is negative for risk. There's an inverse correlation between bond prices and bond yields when bond prices rise, the yield falls, and when bond prices falls, the yield rise. So the way to look at it is just look at the yields. As the yields are rising, that's positive for risk. As the yields are dropping, that's negative for risk. That's the easy way to look at it. Now, looking at commodities, I can see that copper is well supported on the day. Oil is well supported today, obviously on that weak dollar. And we're seeing gold falling at the moment. Now, taking a look at the major currency pairs, we can see broad US dollar weakness heading into that key support level around that 92.20 level. Just look at that on the weekly chart. You can see that key trend line. So the US dollar is testing a very key level here. We did see a little spike higher in the US dollar just before came onto the webinar today, and that was on some Pfizer and biotech news that the final stage of their trials are out and it's 95% effective as a vaccine. So the broad mood in the market is risk sentiment is on. Looking at currencies, we see that the commodity-based currencies, Aussie, CAD, New Zealand dollar, all stronger on the day. And the Japanese yen is also stronger, but the Swiss franc is weaker. So it's a broad risk on tone in the market, okay? So risk on tone markets, we'd expect to see Aussie, New Zealand dollar, CAD strength. So going over to our currency pairs, we can see that we have a bias to buy the Aussie US dollar, a bias to buy the pound US dollar, the New Zealand US dollar, and a bias to sell the US dollar, Canadian dollar. So looking at the Aussie US dollar, notice a couple of things. Notice how closely it correlates the S&P 500. Rising S&P 500 is supportive for the Aussie US dollar. So that positive uptick in US equity futures is good news for the Aussie US dollar. Now, we have obviously got that weakness in the US dollar that we've noticed. That weakness is due to political uncertainty regarding the election. There's potential delay to the US stimulus bill. Fed Powell was pretty dovish in his comments yesterday, and we had some retail sales disappointing. So all of this is just meaning we're expecting to see more US dollar weakness. The Australian dollar is a pro-cyclical currency. So if you notice, since the 9th of November, when we had that very good vaccine news, that's been supportive for stocks and is supportive for pro-cyclical currencies like the Aussie US dollar and alongside the New Zealand dollar. So we do have a bias to this pair. Now the problem is that price is up at these highs around that 0.7330. We don't want to just jump into this trade. We do have an upside bias. We would look at buying it from around the 72.50 region or the 72.20. So any retracements back to those levels could be considered suitable for going long, and you just run stops just below these recent levels here, the 7120, 7130 region, just below this little swing point here. Now, when would you get out of this trade? When you get out of this trade, a number of reasons. One, there's a big sentiment shift. And there could be some sentiment shift coming up, some economic data. We'll cover that in a minute, but there is some employment data coming out overnight for Australia and out of the Reserve Bank of, not Reserve Bank of Australia, but out of Australia. We'll cover that in a minute. We could also see, if we saw strong US dollar bids on a lot of US dollar buying, then we'd expect to see the Aussie US dollar pair fall. So if there was something market moving that was very negative news that resulted in the US dollar gaining as a risk currency, then we'd expect to see Aussie US dollar weakness, and that would negate the outlook for this trade. That's two of the reasons that would negate the outlook. Remember, we always want to find what would invalidate the trade. Obviously, our market's going to a risk-off tone. So that's the bias we have, Aussie US dollar. We have our currency pair to trade. Now, there's a couple of things to be looking out for. So first of all, in the risk calendar, we have coming up at 2:30, just over an hour and a bit away here, UK time, hour and a half away, we have CPI data out of Canada. Now, the CPI data is the inflation data. Now, if we go to the Bank of Canada's last interest rate decision, here it is here. I've just put it on the screen. I'll also send a link for you guys in the chat box. Now, this is the last decision from Bank of Canada, October 28th. And basically what they said about inflation, remember, we always want to get the significance of an economic event from the central bank themselves. We want to see what they say, what they're thinking. And they tell us what they're thinking about inflation. They say that it was at 0.5% in September, that's the year-on-year figures, and they're expecting it to stay below 1 to 3%. Measures of core inflation, these are the key ones that the Bank of Canada look at. You can see this reported on forexlive.com, so do go along over to there. We're looking at the CPI trim common median. They're all below 2%. Now, if you just take a look at the, I'll just show you. You just take a look here, the CPI data here. You see the median trim common. See all the last data point, 1.9, 1.8, 1.5. So the Bank of Canada are saying that they're all below 2%. That's what we're kind of expecting. And they say that we're not going to raise interest rates until 2023. So the Governing Council will hold the policy interest rate at the effective lower bound, or as a keeping interest rate, so until economic slack absorbs so that the 2% inflation target is sustainably achieved, right? In our current projection, it doesn't happen to 2023. So what they're saying is that they're only really going to think about raising interest rates when inflation gets above 2%. So that means if inflation does come out above that 2% target, say you get something median trim coming up above 2%, say you get the common coming in about 1.7%, then we'd see CAD strength. So that would be a very potential trade to look at in shorting the US dollar CAD. So have a look at that. That could be a potential market. At the moment, retracement up to that 1.3100 can be considered suitable for shorting for today. But if you've got a very, say we get like a strong inflation data out for the Bank of Canada, and we have a clean break of this level to the downside, then you can look at a retracement back up to that 1.30, 50, 60 region, okay? So we want to keep a careful eye out on that currency pair, particularly as we're going into this CPI inflation data that's coming up at 2:30 my time, which is currently 12:45 just gone. So that's one to look at. Also looking out for employment data. Now, the Reserve Bank of Australia, if we just go over here, these are monetary policy decisions of the Reserve Bank of Australia. I'll also just send you the link in the screen. And you see, what I'm demonstrating here is this is how you go about understanding the significance of economic data. You look at the central bank statements and you look for what they're saying about the data. Now, what this Reserve Bank of Australia said, they basically said they don't expect to increase the cash rate until actual inflation is sustainably within the 2 to 3% target range. They basically said that they don't expect that to happen until 2023. And it says for this to occur, wage growth will have to be materially higher than it's currently. This will require significant gains in employment and a return to a tight labour market. So what that means, as the RBA data comes out, if there is a strong employment spike, so say you see a strong tick higher employment numbers, and you see the unemployment rate, dropping sharply, say it's like 6.8%. Employment is what's expected. Expected to be -26. If that's positive, if that's like sort of +45, +50%, if unemployment rate is -6.9, then that's going to be positive for the Australian dollar, and we'd expect to see more Aussie US dollar upside. So that could be, say you're around for that. One way to deal with that would be to look for a break of this level to the upside on positive employment data and a retest around that 7330 level. Okay, this is not just trades to jump in. This is using central bank analysis. This is how professional traders trade. This is how you work out which data is significant versus which data is not significant. Okay, so that's how you go about making those decisions on a day-to-day basis. Now, do you have, guys, any questions to to be asking. But they're the key events. We've got a whole swathe of the central bank speakers as well: Bank of England, Bank of Canada, ECB, Federal Reserve. But the main event, risk event coming up is that Canadian CPI data. Any other questions? Please do ask your questions in the Q&A box. It's there, and if you've got any trade ideas and you want me to give a view on that, I'm very happy to give a view on any trade ideas. I'll just share with you when I'm waiting for a trade that I'm in. This is one of the trades that I'm currently in at the moment. Again, this is not an invitation for you to trade this. I'm just explaining my rationale and my thinking. So I've entered a euro pound short. I'll explain why. You can see here that the euro pound pair is being offered. I'm looking at this from a monthly chart, and I'm taking the view that a Brexit deal will be done, and I'm looking for a move back down to that 0.8420 level, and I'm looking for stops just running above these recent highs, 0.9200 on a swing trading basis. And the rationale for the trade is that a Brexit deal will be done. I'm anticipating a Brexit deal to be done, so I'm looking for the market to break lower on that anticipation. A Brexit deal will be done, and this is just basically on the logic that as long as the EU and the UK sides are still talking, that means a Brexit deal is more likely to occur. Most investors are core long the pound. They're expecting a deal to be done, so therefore I am buying the pound in anticipation of that deal. The risk to the trade is if the EU and the UK walk away. So if the EU and the UK suddenly decide they don't like the deal, they're going to walk away from it, then you'd expect to see heavy buying in the euro pound, and you expect to see the euro pound moving up to that 0.9500 level. If that was around on the squawk, I would immediately stop and reverse. But you'd have to have a definitive walk away from the deal. But many markets are just not anticipating that to happen. So of course, two things to realize. One, if it does happen, there'll be a sudden reversal in the pound, and expect to see a lot of weakness in the pound. Otherwise, I am be happy to buy the dips in the pound in expectation of a deal. The reason I'm shorting the pound against the euro is that we've got rising COVID cases in Eurozone. We have the ECB, which are looking at increasing the PEP bond purchases and tweaking the TLTRO program. So the ECB is looking at a more negative bias at their next interest rate statement around December. So remember what I'm trying to do. I am trying to pair strength against weakness. So you can see here, strength against weakness. Okay, right, got a question here. Let me just. Okay, from Nike, let's have a look. So Nike asks, how about on the fiscal side? How do we do some research on this? Well, you can find fiscal stimulus. More and more fiscal stimulus is coming in. So here's one fiscal stimulus aspect, which is debt. Okay, the countries with the lowest percentage of debt to their GDP are more able to add fiscal stimulus, Nike. Okay, so you can see here, like a country like Germany has only like 50% debt to GDP ratio. Whereas the UK, we've got about over 100% debt to GDP ratio alongside Spain and Belgium. So Germany has more fiscal stimulus that they can use than the UK, Spain and Belgium. Look at a country like Norway, has less than 50% debt to GDP. It can very, very comfortably have a huge amount of fiscal stimulus if it needs it. So the first thing you want to look at is a debt to GDP ratio. Then you need to look at what happens from central governments. And the best place to do that, Naki, is you want to do some research. You want to look at websites like ING. You want to look at websites like forexlive.com, Financial Juice, okay, things like that. And obviously Bloomberg. And the other thing you want to look at doing is getting access to a professional news source. You know, that would be very, very helpful for you to have access to that professional news source, and would give you access to it. I can give you a free trial access to a professional news squawk, Naki. I've got like a 2-week free trial, and this is like with a RAN squawk service. I'll just give you that. I'll just give you that access now. Hang on, I'm just going to get you a link that helps. I'm just going to find the right one. Yeah, okay. So this, you know, really, when you want to do it, you've got to use paid services really. Eventually, you can do quite a lot, Naki, on your own, but like getting access to something like a RAN squawk would really give you that extra edge. Yeah, nice one, Titus. Titus is asking some questions here about oil, saying that he is bearish on oil, but it seems a strength to the upside. What's your take on oil? Okay, so this is what's going on with oil. Okay, oil is moving to the upside on optimism that a vaccine is going to get life back to normal. Oil is also rising on optimism that OPEC Plus are going to agree a 3 to 6 month extension of their production cuts. So that's what's underpinning oil at the moment. And the other thing that's underpinning oil, of course, is the weak dollar. So they're the 3 upsides for oil. But here's the risks for oil. The risks for oil, let me just find oil demand charts. Here it is. This is some of the risks that we've got for oil, you see. That if full production comes back in from Libya and Iran, then that means that the total production, if there's no rollover cuts by OPEC and Iran starts resuming the exports, remember Iran's been frozen out because of the nuclear deal with President Trump, and that Iran's currently producing about 0.5 million barrels per day. If Biden says it's okay, you know, takes a more conciliatory view to Iran, then Iran could resume full exports of 2 million barrels per day. So the worst case scenario would be that there's a supply glut of 28.4 million barrels per day, but only a demand of 26.5 million barrels per day. So that's the issue for oil, Titus, is that possibly there could be an oversupply. But at the moment, you've got to say, look, yeah, the market's coming into this heavy resistance area here. So that's going to be the key area. If that area breaks, then you'd have to say higher prices are ahead. I mean, there's some pretty strong technical momentum heading up towards this 44.45 region, okay? So that's key level. So prices at a key position right now, and there's some of the things to be balancing. Now, what we're going to look at is see if OPEC decide to do production cuts. If OPEC cancel their production cuts, you expect to see some near-term weakness in oil. If OPEC extend their production cuts, you'd expect to see oil keep moving higher in the current marketplace. And particularly keep an eye on the US dollar. When the US dollar is weak, that means that commodities gain. So a weak dollar will also boost oil higher as well. So I hope that helps. Okay, been looking at platinum. The fundamentals are in favor of push to the upside after strongly breaking above 900. Yes, that's yes. I'm just going to see if I've got anything on platinum to help. I may have some good information on platinum. Just give me a second. I'm just going to quickly look on another screen. I do have some good data on platinum from a seasonal perspective. Yeah, okay. So from a seasonal perspective, right. Okay, let's have a look. I'm just sort of seeing something around these current dates. That's 10 years, let's have a look, 25 years. Yeah, okay. Yeah, here we go. I've got a good one. I've got a good one here for platinum. Okay, this is the seasonal profit in platinum for the last like 25 years. Okay, I'll show you this here. So this is platinum over the last 25 years. I've just dug it up. Hang on a minute. Where did I put it? There we go. Right, okay. Apologies for that, but it'll be worth the wait. Right, so this is a chart which shows the cumulative profit of platinum if you bought on the 2nd or 3rd of January and held until the 1st of March. If you'd done that over the last 25 years, you would have had 22 gains and only 3 losses. Okay, so it has a huge annualized return, about 88% of winning trade. So buying in January and closing the 1st of March resulted in this amount of profit. The maximum profit was 44.99%, and the maximum loss was about 12%. So you can see that's a pretty good return, and an annualized return that's pretty solid on that platinum. So that's a seasonal demand for platinum. Now I'm not sure what that seasonal demand for platinum is, and I hope that, but I hope that helps you guys. You know, now obviously platinum did lose 3 times, so just because you buy platinum the 1st of January, it doesn't mean that you're definitely going to make a profit. So just be aware. But this is the seasonal pattern for platinum, and I'm sure you can see that's pretty good. So that's from 1995 to 2020. Yeah, pretty solid, isn't that? I have to look into that to see what the reason. Titus, you can maybe look at that and come back next week. Let us know what's the seasonal reason for demand in platinum. That is such a strong pattern. There's almost certainly going to be a demand. So it could be, you know, it's an industry. That's when industry like to buy their metals, you know, etc., etc. There'll be something there. Yeah, Nike. Yeah, I tell you, a name change wouldn't go amiss. It would be appreciated. It's strangely distracting. Warren, I think US oil is moving in the range, and it will continue. No surge in oil price, but bias is more sell than buy. Yeah, it's just you know, put a gun to my head. I'm a bias seller as well. Yeah. The only thing that worries me about it is that there's been quite strong bullish sentiment. There's bearish reasons, there's bullish reasons for oil. So I can see a case for buyers, I can see a case for sellers. I prefer to trade markets when like there's no case for, you know, it's all one direction. You know, The OPEC Plus coming up December, I think they're going to, you know, one way of trading this is waiting for the headlines on whether OPEC Plus extend cuts or don't extend cuts. No extension, oil sell, extension, then that's what I think the market's sort of starting to price in. Yeah. Yeah, another asset that Titus has is copper. I don't see copper breaking below 3. I'd agree. And the demand for electric vehicle goes up. Copper demand is bound to increase. Is the current price of copper sustainable? That's the difficulty, Titus. You know, this is a very, very extended market. Okay, and we're heading into key resistance around this 3.3, 3.2 level, right? So where do you get back in? Like a couple of tricks. Okay, so you know that typically whenever you get to these kind of big levels, right, you expect to find profit taking. So profit taking is going on. Now, a retracement back to 3 could be very good. If we get retracement back down to this level, that makes sense for copper buyers. Right. Now, even if price goes down to here, would you still be bullish on copper? I would be, because of the extra demand that's going to come into copper from electric vehicles. So it is a buy. So it's just using the technicals to find a way. So what I do is I look, if there's a retracement from here, which you expect you might see, and then draw a trend line connecting the retracement and then trade the break to the upside. You see where I've done that here? So that's the trend line. We've got a pullback, break of the trend line, entry on the break of the trend line, run your stops below the latest swing point, and if price goes back into this trend line, you can exit. Okay, and just trade that trend line break. So that's what I'd suggest, Titus, is just keep looking there. You know, trend line break to the upside, trend line break to the upside. You could argue that this is a trend line break to the upside here. The bit I don't like is this overhead resistance. So all markets going to pull back, even healthy bull markets. And in fact, a pullback is a sign of a healthy bull market. So just fiddle around with the trend lines and trying to find entries as you go in. Another one worth considering is nickel for the next 5 to 10 years. I've got a couple of articles on my blog, so do check out my blog if you want. I'm just sending you a link, which is my blog, and there's a search function on my blog, and you can just go and search. You know, I'll show you here. Put some pretty good material up here. It's really interesting and like just be really beneficial for you. So if you look at this, you know, it's always the way, isn't it? Maybe under copper. Right, I think maybe I mentioned about nickel on forexlive.com. But anyway, you know, there's a search function here. It's pretty good, and you can find those things. Okay, Titus, hope that helps. Yeah, okay. Yeah, Titus, Bitcoin's on a crazy run today. It is, isn't it? It's nuts. Bitcoin just keeps going. Yeah, there's all-time highs, you know, up at that 20. You know, I bought Bitcoin. I bought Bitcoin on this very simple trend line break. It was, what was it? I think I shared it with you guys. I bought Bitcoin on this trend line break of this trend line here at around 10,800, and I took profit at 1480 odd. Just under 1500, I took profit just simply because, you know, what a run. And look at that, it's gone even almost double that. And that was, I made 10% of my account. And I just thought, I can't psychologically lose that. I've got to take that 10% in, and look, I should have held, so it's a bit annoying. But you know, can't complain with the 10% profit on the account. That was my biggest single winning trade of the year. My one before that was a gold long. So yeah, into key resistance here. So expect buyers. Where to re-enter. It's just such a big market, Titus. Like for me, I just wouldn't bother chasing this now, because again, you can look for a retracement and then go for a trend line break. That's probably the best thing to do, Titus. Otherwise, you know, where'd you enter? Like 1700, 1600, then where'd you put your stop? 1200, 10,000. It's tricky. It's too big for me. So like a deep pullback to 1400, maybe I consider getting in. But aside from that, you know, just look for a trend line break. Again, similar to copper, Titus, you know, when you get these big trends, you don't want to force the trade. The last thing you want to do is start buying up at these highs, and then you get what, like a $3,000-4,000 retracement, and it's still a bull market, but you've just bought at the wrong point. So that's what you got to watch out for. Gold. Titus, I'll send you the name of that, where I got those charts from. Nura, what about gold? Any technical analysis? Yes. Now, gold. Let's just. Right, gold's in a bit of bother at the moment, and it's the spike in the 10-year yields that's created the problem for gold. If you look, you can see yields drop, gold rises. Yield drop, gold rises. Yield rises, gold drops. This is the blue line is the US 10-year yield, Nora. So remember, gold and the US dollar are very, very closely correlated. This is the 10-year US bond. Right, as those yields shot higher, this is on the vaccine news, gold falls. Why? Investors are expecting life to get back to normal, eventually interest rate rises, yada, yada, yada. Gold no longer so necessary. The spike higher is bad news for gold buyers. Okay, 10-year yields have pulled back a little bit. Obviously, we got the vaccine news is good, but we've still got a time before the vaccine is rolled out. So the market's balancing the long-term optimism picture versus the short-term concern about rising COVID-19. So look at your 10-year yields when you're looking at gold. That's what I'm trying to say. If these yields move higher, then that weakens gold. If these yields move lower, then that strengthens gold, and obviously the US dollar. So a weak US dollar is potentially good for gold. That's why we're seeing gold just finding this support, but it's that heavy sell and gold is struggling. Now, if we get above this, buyers will need to see, obviously the yields dropping above this trend line, Nura, and I consider entering back into gold. One seasonable, I'll give you a seasonal fact about gold. There's a very strong seasonal pattern in gold, and I'll show you it here. Okay, so in the last 10 years, if you had bought gold, right? If you bought gold the last 10 years on the 27th of December and held it through to like 20th of Feb, you would have made money every single year apart from 2012. Now, the reason for that strong spike in gold, so that remember that's buying gold about Christmas time, 25th of December, 27th, 26th of December, and holding it till about 20th of February. If you've done that in the last 10 years, you'd have made money every single time apart from 2012. Can anyone tell me why? Because now there is a reason for this. Why might it be? Thanks for answering the questions and that. But I'll tell you the answer. The answer is Chinese Lunar New Year. China is the biggest physical gold buyers in the world. The China Lunar New Year is take place at the start of the new year, so lots of people buy gold for those celebrations. That's why gold prices rises. So Nura, the fundamentals, the technicals for me, waiting for this end of December, might consider a buy. Also, a drop down into this support level here, 1800, could consider a buy, trying to move higher. Breaking this key trend line I'm looking for, but I'm just conscious, huge selling gold, a bit of a fundamental shift. Okay, Nura. So I am not entering the market now in gold. I'm waiting. I'm patient for that. Yeah. Hope some of that helps, Nura. Don't forget, come here, guys, each week. Got plenty of information, plenty of good stuff to share with you, just like that. I'll give you one little last nugget. Where is it? Here. Just give me a second. I just got to find the right screenshot that I've taken. That's always the way. You can't see it when you need it. Let's have a look. There it is. Yeah, this is the pattern return of the S&P 500. Okay, so buying the S&P 500 from the 22nd of November through to the 2nd of December has won 8 times in the last 10 years. There's been 8 gains and 2 losses. Now, some of that is due to the money from bond yields, bond coupons, comes into the stock markets, I think, around this time. So you get a good, strong return from the 22nd, 23rd November through to the 2nd of December. You can see that the general profit has been good over the last sort of 10 years. So that's come up with the S&P 500. So, you know, positive vaccine news for me, you know, how would you use that? Well, I wouldn't necessarily just trade that straight, but any retracement back on the S&P 500 could be considered suitable for, you know, for buying. So looking there, looking on the daily chart, you know, like, okay, good area for potentially buying would be here. 3,525. I'd expect buyers from that level. If you can get that before 23rd November, that would be great for a potential spring move higher. Guys, thank you all very much for your time. If you, yeah. There you go, Titus. Okay, everybody, thank you all very much for your time. It's been a pleasure. And don't forget, we'll be back here Monday next week, 12:30, and back here on Wednesday. Hope it's been good, guys, and you picked up a few good nuggets. Thank you all very much for your time, and I'll be in touch. Thanks, everyone. Goodbye.